This morning, the company reporting a first quarter loss of 32 cents per share, revenue coming in at $10.13 billion versus $10.11 billion expected. Overall bookings just shy of estimates, $37.65 billion versus $37.93 billion. Joining us right now is Dara Khosrowshahi, Uber's CEO. Dara, we appreciate you joining us this morning. Want to talk about the report. I think it surprised some. You're looking at the stock down just a bit on the back of the news, I think in large part because you had been hitting, you'd become profitable last year, and then here we have this loss this year.
Yeah, I think when you look overall at the results, they continue to be consistently strong, right? If you look at our top line growth, gross bookings growth up 21% on a year-on-year basis, incredibly strong. And if you look at the midpoint of our guidance for next quarter, we're between 20 and 21%. EBITDA growth up over 80% on a year-on-year basis, and then 1.4 billion of free cash flow during the quarter, over 4 billion of free cash flow next quarter. Now, the reason why we moved into a loss, the biggest reason why we moved into a loss was that we've got significant equity stakes in certain companies like Didi and other companies out there. And we had to take a markdown of over $700 million for those equity stakes. Has nothing to do with the operating business, but we did have to mark down those equity stakes that resulted in a loss. We don't expect that to keep happening going forward, but you can't, as you know, Andrew, predict the markets.
So when to the extent that investors should look through those equity stake write-downs, if you will, and look at the operations. When you think about the operations over the next 12 months, how's it looking to you? Because we've had now a number of CEOs come on over the past quarter, this whole earnings season, and say, you know what, it feels like things may either are soft now or going to get softer in terms of what their expectations look like.
Yeah, we keep looking for signs of softness just because we read all the news that you read and talk to the folks that you do as well. But we're not seeing signs of softness. If you look at our guidance, it's between 20 and 21% for next quarter. That's super strong. When we look at consumers, are they trading down, for example, on Uber Eats? Are they eating at less expensive restaurants? We see no evidence of that. Frequency is up. Our both retention is up in mobility and delivery as well. So we're not seeing the kinds of signs of weakness that other folks are talking about. Hopefully that'll continue. One interesting trend that we're seeing is that people are getting back to work. Actually, if you look at workplace and you look at commute and office, people are absolutely getting back to work. Our workplace hours are stronger than, let's say, leisure hours. And also travel continues to be strong as well. Travel grew at very significant rates on a year-on-year basis.
Speak to the issue of pricing on the mobility side. This is getting picked up in a car. Given that, in truth, it appears that Lyft, your biggest competitor, has gotten more competitive, or at least tried to get more competitive on price. Has that forced you to bring prices down in certain markets?
We see pricing in the U.S. as being stable. So you saw our mobility business, for example, grow 26% on a year-on-year basis globally. So the growth rates that we're seeing are very significant. And overall, the majority of our growth is coming from audience growth, for example. Our audience increased 15% on a year-on-year basis, and frequency as well. People coming to Uber more, especially as a higher percentage of our consumers become members of the Uber One program. Frequency is up 6%. Gross bookings for us grew 21% year-on-year. Trip growth was 21%. So we're not using price to drive growth, which might be different than some of the other companies out there.
Speak to the Uber Eats piece of this. That's always been the piece that you've continued to invest in. And the question is that part, how quickly is that part of the business going to be profitable?
Well, that part of the business is profitable, happily. So our growth rate was consistent this quarter, 17% on a year-on-year basis. Most of the growth is coming from audience and frequency. Retention rates are up as we continue to add selection. We've got over 1 million members now, 1 million merchants now on the platform. So we're seeing eaters come back to us more frequently, more predictably as it becomes kind of a habit, so to speak. And we believe we've gained category position in 10 of our 10 biggest markets on a global basis. So Eats continues to grow. and at the same time, it's profitable. So adjusted EBITDA for Uber Eats business was at a record margin, 3% of gross bookings, up over 80% on a year-on-year basis. So we're now at a point as a company where we can continue to grow at outsized rates compared to our scale while continuing to increase profits and increase profit margins.
Yesterday, you announced a deal with Instacart where folks who are using the Instacart app effectively can use your service. How much is that going to be a game changer or not in terms of what it means over the next 12 months to the business?
Well, we're very excited about the Instacart partnership. We view it as being highly strategic. When you look at our penetration, especially Uber Eats penetration, and you look at our category position, we are super strong in the big cities. And you'd expect that, right? The Uber name it's kind of an urban kind of a brand. And we believe our most significant growth opportunity in the US is in the suburbs, is in the less dense areas. That's an area of strength for Instacart. They wanted our content because they know we've got the best selection, the best service, the best pricing out there. And so we now get to put the Uber Eats brand and service in front of, the over 10 million Instacart customers who tend to live in the suburbs, tend to be highly affluent, kind of shop with big basket sizes. So we're very, very pleased with the partnership and the potential that we see going forward.
How much of that was about trying to box out DoorDash?
Well, we compete with DoorDash every day. So I wouldn't say it's necessarily trying to box out DoorDash, but they're a strong competitor. We think we're a stronger competitor. And we think that having access now to the Instacart customer, that tends to be, there's a lot of overlap between the Instacart and the DoorDash customer. We think that's a strong strategic move. The deal is going to be profitable for us. So we kind of have the best of both worlds in terms of top line growth and profitability. That's highly strategic.